Hi, it's Aoife Devitt. Welcome to today's Markets Happy Hour podcast. It is July 17th, Thursday, and I'm delighted to be joined by Euan Munro as my special guest here on today's podcast. Welcome, Euan. Thanks for joining us here.
Thanks very much for having me, Ethan.
As usual, I'm going to share the slides, and I've called today's podcast The Waiting Game because it seems that we are, perhaps some of us sitting on deck chairs, some of us not, but we are certainly waiting to see the outcome of some of the tariff discussions and some of the earnings now that are coming around for the second quarter. So there's a little bit of a waiting game going on in markets and not a huge amount of activity over the course of this week. As I mentioned, delighted to be joined by Euan here. Euan is the former Chief Executive Officer of Newton Asset Management. He's a frequent speaker and commentator on market conditions, multi-asset portfolio construction, and a wide range of other areas of interest to investors. And I thought it'd be great to invite Euan here to hear his always refreshing views on some of the topics that we cycled through. As usual, we cycled through inflation, interest rates, equity markets, geopolitics, and other asset classes. And this week in particular, I mentioned the waiting game around tariffs, but also a little bit of a waiting game around will he stay or will he go with respect to the beleaguered Chairman Powell of the US Fed, who seems to be under assault again this week, and markets have reacted in kind. We're seeing equity markets on a streak. It is a fairly narrow one, not particularly broad. And then looking at other assets, we do have Bitcoin continuing to enjoy its own streak, and we'll look at some portfolio implications as well. So just kicking off with inflation, we've had some numbers on inflation. We're both in the UK today, but the US has had its numbers a little bit too high for comfort. According to Bloomberg, we see that services are keeping price rises reasonably high. We also know in the UK they've been higher than expected. And overall, this is giving some cause for a little bit of concern, it seems, certainly to those central bankers who thought that inflation was in the rearview mirror. I will show later that this is not necessarily a synchronous story around the world, that of inflation. But what are your thoughts on what you're seeing here? And is this kind of playing out as you would have expected when it comes to these inflation numbers?
Yes, I suppose it is to some extent. Certainly, you mentioned the UK inflation. I think the headline today was it's surprising on the upside. I don't think it's that surprising when you increase the minimum wage and you increase the national insurance contribution for workers that your haircut price goes up, and so service inflation is linked to those factors, and that's not been. There's been no easing of pressure there. In terms of the other major drivers of inflation, they're quite long term. You know, the sort of effect of becoming less globally integrated, the actual imposition when it happens of tariffs on a significant scale should be inflationary, but it hasn't happened yet. And so I think there's an awful lot of undecided questions around future inflation. So I think the pressure remains on inflation, and that's why we're sitting with in much of the Western world quite high interest rates, quite high bond markets.
And it's fascinating. We'll certainly get on to the bond markets around that point of tariffs. I think it is probably too early to say whether or not tariffs will affect inflation. We have heard President Trump endorsing companies to eat the tariffs, not pass through the prices. We know that there has been an increase in tariff revenue, certainly in the second quarter, quite significantly higher than this time last year. No surprise, the tariffs, the 10% minimum, has led to an increase in tariff revenue. Yet inflation is still somewhat subdued. Do you think we can conclude at this point that tariffs will have no effect, or is it far too early to say?
I still think it's too far early to say. We did see quite an increase in inventories, people trying to beat the tariffs in the US. So there was a lot of raw material and stock bought in ahead of the imposition of the 10% base tariffs. And so once they actually have to go out and buy fresh stuff subject to the full tariffs, it might be more inclined to pass that through to the end customer. So it's possible that the tariff revenue that we've seen, so far, hasn't yet got to the high street.
Definitely too early to say. And I think the really other interesting factor is inflation, of course, is very unevenly felt. You spoke about haircuts that would generally be seen as a non-negotiable aspect of the household budget. It does seem that the basics are rising, wage hikes. This is a US number on the top left that we're not the wages are not following in suit at least. So it's becoming disproportionately more expensive for the lower end consumer. We're also seeing this gap around the US and non-US. We've spoken before about the fact that there was a sort of a security around the inflation numbers coming down in Europe, but not necessarily in the US or the UK. It seems that there is kind of a sizable drop in inflation in Europe. And then numbers coming out today around China struggling with deflation, something that we haven't had in our headlines for a while. Japan struggled with it for decades, but China seems to be on the other side of this. Any thoughts? Is this again, as you would have thought, given the economic trajectories of these non-US markets?
To some extent, yes. I think it's also a reaction to the path of the dollar. So the dollar has obviously been weakening against the euro and against other Asian currencies, which in real terms means that there should be less inflation pressure. The euro goes further, the dollar goes less far in terms of the international clearing price of commodities, etc. So I do see that there's a link with the purchasing power of various currencies, but also the US is running quite hot. The US is running a significant fiscal deficit. Trump's just announced his big beautiful bill. He's not planning on pulling back on not spending money either. He might spend less at the government level, but give that back to consumers to spend through tax cuts, etc. And so those big deficits are directly feeding into economic growth. The question is how sustainable is it to continue to spend at that level, which itself is a function of how much feeds back through into higher growth. So I think the US is running hotter than other economies in terms of government stimulus, and it's got a weaker currency, and I think that explains pretty much the difference.
Really interesting. And I've been using this Table Mountain analogy for both interest rates and inflation. They had risen and were kind of stabilizing at a higher level. I think it is interesting in Germany how that inflation rose and has been coming down in a pretty even fashion, not really a table at all in Europe and perhaps the US, as you mentioned, for those reasons being the anomaly. And I think then just on the point of around the trade war, and I'd love to get your views on this. So we're sort of we don't know at this point whether how tariffs result in inflation, but there is a little bit of narrative emerging because we've seen these receipts. We haven't seen the deals yet, but then the question is, do the deals really matter? Is it really more about the threat and the strong arm tactics? And maybe will the 10% minimum tariff be enough to plug some of the gap? Of course, the big beautiful bill is not yet in place, so we don't know about the extra number of trillions going on the deficit there. Um, any thoughts on this gambit around tariffs and a narrative emerging that this is all going beautifully according to plan?
Yes, I mean, I think clearly President Trump believes in tariffs. He's implementing what he believes in. He thinks that the tariffs are going to be paid by, foreigners that want to sell in the US, and I'm not sure that's entirely true. I think the tariffs will have to be paid by US consumers through the price adjustments that will be made for the price of imports to the US. So I don't think tariffs is a straightforward win-win. There's going to be elements of lose for the US if it imposes these tariffs, not least in the damaging the relations with other parts of the world, and potentially weaning other parts of the world off the use of US technology and US companies. So I think in areas like defense, for example, where I think Europe is very inclined to want to build its own solutions rather than going to North American manufacturers, etc. And that's a number of different reasons for that, including just the concern initially when Trump seemed to not be very supportive of NATO. That created the question, does Europe need to really build its own military equipment, for example? But then the tariffs on top of that give another reason to try and do less business with the US. So I think it's confrontational with the rest of the world. Clearly, President Trump believes in it. I think he's been annoyed by the taco in chief type comments that have been made, and for that reason, he's likely to, at some stage, put his foot down and insist on some measure of tariffs being applied. I think the market's probably a bit complacent about the impact that that will have. I think it will be relatively significant.
And I think a headline like this kind of underscores the desire of journalists to put things in the win-loss column and decide that they're kind of definitive, as opposed to having perhaps the, as you mentioned, the kind of messy reality that, there are some wins, some losses, and sometimes we don't even know because the time scale is uncertain. But I think it is interesting that there's certainly on the back of the big beautiful bill and other wins, there's a desire to frame everything as a win at this point. I think moving to the other drama of the week, clearly Jerome Powell is not going to escape any kind of a summer break. There was a bit of drama about, will he be fired? Won't he be fired? It seems that markets very much to show their hand here in terms of their support of any suggestion that central bank independence was going to be waning. We saw both movement in the Treasury yield, movement in the S&P, and movement to the dollar. And I have a chart later showing how the dollar could even get to a 4-year low, having been hovering at a 3-year low. So I guess there's markets have spoken. And it seems that the suggestion of a firing has been kind of reined in. How damaging is this? And do you think, again, we're oversimplifying here? Because simply the change of chairman is not going to drive the rates to 1%.
No, I think that's right. I mean, the chairman role is very important in setting the tone, but he obviously leads a board of policymakers that will you would hope do their own thinking and have some views of their own as to what the right level of interest rates should be. I think the concerning thing to some extent is just, we all know that President Trump has a different style. He kind of says things that no other president would say, but the net effect is undermining of institutions. And so, whether he has the actual power to fire the Fed chair or not. I think most people judge he doesn't, but he can make life very uncomfortable for Mr. Powell in the short term. But the whole effect is one of interference from the very top of government, and that applies to lots of individual companies as well, being told directly by the president. Whether it's Apple being told they need to manufacture in the US or whatever. And so we've never had a president who's felt it so easy to criticize public servants or business leaders in that very open way. And I think it does undermine stability in markets. So I think the Fed has been weakened by all of the attacks. I think it would be seen as very negative if Powell was forced out in some kind of way. I don't know quite how that would come about, but I think it's very important that the market believes that there is a check and balance, because a government that spends 7% of GDP on its fiscal deficit, wants to give tax breaks to everyone. If there isn't someone sitting on the other side, trying to lean the other way and slow things down, it's a recipe for rampant and uncontrolled inflation.
And you've already mentioned the economy running hot. So there's not a lot of margin for error when we have that kind of frothiness building in there. And I think you're just getting back to the chart around the US Treasury yield, hitting 5.022% there just this week. It seems markets are thinking he'll survive at this current, just as you do. And it seems like Kevin Hassett, Kevin Warsh kind of moving to certainly a lot of the stakes in terms of who's next to succeed. So I'd send a reasonable confidence in both of those names, but certainly would be more inclined to perhaps do the president's bidding. But I suppose then the question is gets around rates, getting back to that spike in rates we saw in the 30 year. It seems that given the inflation numbers, we were at a fairly low probability of a rate cut coming up in September. And on the other hand, we know that these high rates are taking their toll.
Mm.
It's been, kind of a seismic shift in just the prevailing mortgage rates. Nothing close to what was experienced. We've seen a tick up in foreclosure activity. Some of these rates are hard to support. And we know that there's a sluggishness in sales, or at least sort of existing home sales in different regions. So, given I know you know this world of fixed income fairly well. How do you make sense of this rate picture right now in the US?
Yeah, I think the US is in quite a difficult place compared to other economies in that their mortgage rate is linked to the long end rather than what we would experience, for example, in the UK, where short-term interest rates have more of an impact on mortgage levels. And the thing about the long interest rates is that the natural buyers of long interest rates historically were, people with long liabilities, so defined benefit pension providers, for example, or very long dated insurance contracts. And when we went through the period where interest rates went very low, and particularly through the period where central banks were buying lots of bonds to manage the yield curve and pull that down, that crowded in all of those people with legacy long-term liabilities. They had to buy long-dated bonds, and they pushed them down to, in my view at the time, and in retrospect, have been proved right. Ridiculously low levels because they had no choice. They were being forced to do so because of the power of central bank. Otherwise, they would have had very expensive uncovered liabilities. We don't have those liabilities unhedged anymore, and there's no new defined benefit type long dated liabilities being created because they've been deemed to be too expensive by the corporate sector. So if the central bank's not buying long dated bonds, I don't know who is. And so if you're linking, you've got your powers and your central banks controlling the front end, the long end will keep on going up until somebody devises interesting financial products, be that long-term pension products or something like that, that requires a risk-free asset of that duration and that length. And so I think the interest in long dated bonds is very low. I don't really know who, and nobody in retail space wants to buy them, and pensions have been retailized. And so I think it's going to be very difficult for governments everywhere to control the long end. And the US has a particular problem that their long end is linked to their mortgage. So either they develop a long dated product and get demand up for long dated bonds, or people start taking shorter dated mortgages out in the US.
This is a fascinating slight segue I want to make here because this is if that is the case that technical factors will dictate that the demand at the long end is no longer what it used to be and rates stay high. There's a bit of a narrative emerging, certainly in pension fund advisor land, that we're in a new return environment. That we've seen the liability with the high discount rates, we've seen the present value of liabilities come down. These rates remain high for the most part; they haven't started coming down. Do you think that we are in a higher return environment, or is that a kind of an illusion because we have inflation eating away at these returns? If rates stay at this level, 5% or so, are we in just a better return environment all around?
Yes, I think, I mean, to be honest, I think if you can cope with the volatility when you've got treasuries up at 5% as a relatively risk-free nominal return, it's not bad. I actually think that yield is cheap at the moment as an investment factor. I think because you've had the retailization of investing very often on leveraged platforms, people are wanting to buy things that move fast in capital terms. So they want to buy, whether it's their Bitcoin or their Tesla shares or whatever, and they want to buy on leverage and they like things that move fast. And in actual fact, whether it's, long dated treasuries or boring old cash generative dividend companies, they both look really quite cheap to me because in order to make money from them, you need to be patient and you need to just wait for that income to accrue over time. You're not going to get a big, two times capital gain on a leveraged portfolio from something like that. And so I actually think that what we've got is we've got income as being an under appreciated, understudied, underinvested in part of return, and people looking at capital gains, ideally quick, as the way to invest and to make money.
Fascinating. So a new normal, I suppose you could suggest it if that's where we're going. And this
Yeah,
is ironic that this is at a time when we're seeing such new products being developed that are, kind of delivering higher yield, etc. When often the most staple, ordinary products of a portfolio may well do more than we thought. And interestingly, real estate and other, when compared to fixed income, perhaps are not worth the additional risk. It does kind of certainly raise the bogey for some of these fixed income like assets.
definitely, definitely.
Just in terms of, we talked a little bit about divergence, and clearly you mentioned the US and its own kind of having its own path and its exceptionalism in this respect as well. We are seeing yields in, say, China, for example, at historic lows below 2%. So again, I actually did a podcast recently called The EMification of DM Debt, showing how DM was starting to behave like emerging markets in some way. And the irony here is that it seems like some emerging markets are behaving like developed markets, and we've almost had a flip in terms of the yields. Have you bought into any of the kind of changing, perhaps, perception of EM debt, DM? Have you seen anything? Do you think one is mispriced?
Yeah, yes, quite. I mean, I think EMs, just simply aren't allowed to borrow to the extent that developed markets have been borrowing in recent times, whether it was, the explosion of borrowing during COVID or in the case of the US, just carrying that on, whether both under Biden and under Trump, one to fund very expensive carrots, but the Inflation Reduction Act and so on, and then Trump wanting to give tax giveaways and so on. Emerging markets just aren't as indebted, and they're and they for that reason, I think it's appropriate that the spreads have narrowed between emerging markets and developed markets. I think in the case of China, China's finding itself in a very much sharper kind of competitive situation with them being deliberately disfavored versus Vietnam and other places. And so I can understand why they're having to be a bit more competitive. Prices are coming down. And there's also a demographic factor at play in China, an aging population that might be like Japan, wanting to move into less risky retirement type assets. So all of these factors, some of the emerging markets just aren't what they used to be in the terms of some of them are aging in the same way as the West, but some of them have got the advantage that they're just simply not as indebted.
That's a fascinating insight, and I think we probably don't have time to go into the whole emerging market equities picture on that. But I think it just goes to show that some of our assumptions, I think we do have to retest over and over again. Back to, same story in equities in terms of large cap retaining its streak. The Magnificent Seven. This chart shows the Magnificent Seven relative to the Russell 2000. Again, more evidence of this unloved nature of small and mid cap stocks,
Mhm.
to catch a break. I had a discussion last night about the lack of traction of some smaller, mid-size and small cap venture, as well as other smaller private equity. Private companies are not getting the investment if they're small. Public companies don't seem to be attracting much investment if they're small. And then when we look at Europe, we can see that Europe is still doing relatively well relative to the US, but it has still been a little bit of a summer of love for European equities. Any thoughts on this large cap, small cap divide we're seeing, as well as the US, non-US equity relative attractiveness? And it's a huge question to answer in a short space of time. So
Yeah.
bullet points are fine.
Yeah. Well, I think one of the things I talk about is the influence of social investing. So older people like me, who were kind of have been investing for 30 years and so on. We think that things like dividend yield, price earnings multiple are important markers of value, and we start getting nervous when the price is implying that, earnings have to grow at 25% compound as far as I can see to justify the share price. But, on these trading platforms and when stocks become meme stocks, none of these considerations is really part of the discussion. It's really a phenomenon where investors, share their ideas, however informed, on social media or whatever. And as long as there's somebody else going to be coming in and joining in the charge, then the price can become somewhat unmoored. And it's a real phenomenon. It can stay unmoored for quite some time. And it's the point I would say is that these large cap stocks, because they're so frequently traded, and the trading margins are so tight, and you can get leveraged options on them. They're favored trading vehicles within these platforms like Robinhood and eToro and so on. And so people will want to be trading them. Whereas small cap is expensive to trade, hard to leverage, and also you need to do an awful lot of work to understand them. And quite a number of fund managers that used to specialize in small cap, simply haven't been attracting the flows because they've been going to passive investors and so on. So I think the number of people doing the work on small cap has gone down. The number of people that like trading these large cap stories has gone up, and I think it has opened up a yawning valuation gap between the two. I like taking multiple year views on markets rather than trying to predict what's going to happen next week. And my view would be there's some enormous value in the good cash generative, sometimes smaller, sometimes bigger. Just they're a bit more boring and they're cash generative rather than really growthy companies. So they're not going to go up 25% or down 25% in short order. And that's where I'd be focusing. As I said earlier, I think income is the unloved factor in investing right now.
Fascinating. And patience, the need for patience is a motif that we keep coming back to. Just very quickly on the non-US, I presume you've been a global investor for most of your career. Would you still say for a US dollar denominated investor, still advise a global portfolio?
I would, yes. I think I always believe in diversification, and I think like for like. I mean, obviously the American market isn't as expensive as it looks once you strip out the Mag 7, but it still is like for like a little bit more expensive than the rest of the world, and so I think, why wouldn't you want to diversify your bets and buy into some attractive and cheaper, good quality companies? The other thing is that, the tariffs and so on could be detrimental to the US economy, and buying national champions that aren't very dependent on trade in other parts of the world could be an interesting strategy.
Well, we have a very short amount of time to cycle through some other huge topics. So I would appreciate that. And I'll be very quick here because I think one of the things you mentioned is patience. And I thought I put in this chart from Diageo showing the progression of the share price over the past, say, 5 years. Deborah Crew has just left as CEO there. We can see it continued to decline after she joined, but it was already in decline. And I think stresses just how there are some structural shifts in consumer demand. Certainly not the first we've seen, whether this is a shift away from alcohol into healthier lifestyles or just a misfire in terms of some of the celebrity brands and just being in the wrong place at the wrong time. I think, definitely having a patient long-term view, but still being mindful of some sort of structural shifts is a good reminder. The other charts I'd shown, again, Bitcoin, just since we do have an other category, this is continuing to hit an all-time high. I think the interesting data point is it hasn't hit as many all-time highs in this past year as it did in its early days, suggesting perhaps a slightly thinner market maybe in terms of who's actually buying Bitcoin, although this is the ETFs, so clearly strong demand for ETF exposure. And then just some of the other assets that I know you would have been looking at. We have the dollar here touching, could it go to a 4-year low that was mooted this week? I think we would probably both agree that nobody can really be agnostic as to dollar direction if you're managing money. Certainly, as a UK fund manager in dollars, but the other factors are clearly AI is continuing at a pace insensitive, it seems, to geopolitics, to domestic politics, to tariffs, and we have gold kind of flatlining here, not losing value, but still not seeing a great deal of action in the last week. So I've thrown out a lot of topics there. I'm not
Yeah.
sure, given your multi-asset origins, whether you have any thoughts on any of those sort of
Just picking up on one, the sort of Bitcoin maybe versus gold and so on. The big argument for Bitcoin that is that obviously what the real aficionados like to talk about fiat money. The dollar. It can be printed. It can be. The money base is expanded, and that is a reason why Bitcoin should be up so much, and indeed gold. But I was doing a little bit of work on this recently, and over the last 10 years, the US monetary base has expanded about 400%. So that's money in circulation, cash in circulation plus sight deposits. So a fairly narrow definition of money. It's about 400% up. 395% was the number I got. Gold is up about 133%, so it's doing a job of keeping pace. And Bitcoin's up 29,950%. So in terms of its efficacy at counteracting expansion of the monetary base, it's kind of 2 orders of magnitude too significant. So in other words, it could fall by 90% and then by 90% again and still be doing its job. So I think my view is I understand the logic. I just think it's done too well. And I would be more happy with gold if that's the rationale that you're wanting to own something that can't be readily printed and debased. But that's my tuppence on that subject.
Well, absolutely fascinating, you. And I wasn't disappointed. I knew I wouldn't be disappointed. I think this was a fantastic, broad discussion. Thank you for so seamlessly and effortlessly shifting from asset to asset, and we did manage to throw in quite a bit of portfolio implications as well. Thank you for coming here and sharing your insights with us.
Been a pleasure, Raven.
I'm Aoife Devitt. Thank you for listening to the Markets Happy Hour podcast.